Yo, what's going on, guys? Welcome back to the channel. In this video, I want to prove to you why I think I just found the best dividend stock of all time. And that's a really bold claim where I literally think if you're a dividend investor, this is a no-brainer. This should definitely be part of your portfolio, but this isn't personal advice. This is all just my opinion. So I just want to show you the research that I just did. I want to share it with you guys, and then you can make your own opinion because I literally cannot find anything wrong with this company. They're growing their net income. They're growing their free cash flow. They're growing their dividend. They can actually afford to double their dividend right now, and they're doing tons of stock buybacks, and they're trading at a very, very fair valuation. Actually, they're undervalued. They're severely undervalued, in my opinion. Without wasting any of your time, let me go ahead and show you the stock I'm talking about. It's one we've all heard of and probably doesn't get talked about a lot, but I want to share with you guys why this company is so important. So look at this. This is ticker symbol CMCSA or Comcast, and we're going to explain. I'm going to show you exactly what they do in a little bit, but let me show you a little bit about the company first. So they're trading at a free cash flow yield of 8.61%. And if you don't know what the free cash flow yield is, it's right here. You can read it. It's the inverse of the price to free cash flow ratio. So they also have a dividend yield right now of 3.11%. And that's actually a very, very solid yield. And we can see that they can easily afford to double their dividend if they wanted to. So in the meantime, they actually in the trailing 12 months have bought back 5.79% of the entire company. So on top of the 3% yield, they've bought back 5.8% of the entire company. So your actual shareholder yield is an 8.9%, which is crazy. And that's obviously easily covered by the earnings yield, which is the net income. They could choose not to do the stock buybacks, but they're choosing to do the stock buybacks because they have nothing else to do with the money. They're already investing in the future. They're already doing a dividend, and they just have nothing else to do with the money. They have a huge market cap. And here's the valuation of the company. This is really solid. Look at the forward PE ratio of 9.15. They're literally trading at 9 times net income or their PE ratio. And currently on the trailing 12 months, they're trading at a 10.59, which is also super cheap. We have every tech company, 20 forward PE ratio plus, which is kind of crazy. But the PE ratio, forward PE ratio, both make sense on this company. So the valuation makes sense. And I also want to show you the list of assets that this company actually owns because a lot of people don't know about this. I'll quickly scroll through these. You've probably heard of some of these, probably haven't heard of some of these, like Zumo, Xfinity, they own Comcast, and every single thing that you see on here, they own, like NBC Universal or Universal Studios, the huge movie makers, and they also have a bunch of theme parks. I am still scrolling here because they own a lot of these stuff. They have some stakes. So they have a stake in Snapchat, BuzzFeed. That means they own a small ownership of it, which is pretty cool. But, Universal TV, all this stuff. They also own Rotten Tomatoes. Basically, all this stuff that you see here, they own. But I want to go back to their investor presentation and show you the Q1 2024 highlights. So this is the most recent investor presentation. So this is what we really want to be looking at. And we can see that they made $4.5 billion of free cash flow, and they returned $3.6 billion of that through stock buybacks and dividends, which is amazing. And here are all the drivers of future growth for the company. And this is what I found really impressive about the company, is that their theme parks. So I want to scroll down and show you that a little down here. They have some pictures down here, but they have this, like a Nintendo Super Mario World Donkey Kong Country opening in Japan, and it's in the final stages of completion. So they also have a collaboration with Nintendo, which is really, really cool. But let me go and show you a little bit more about the company. Here's their free cash flow and capital allocation. This is their dividends per share. So they have been raising their dividends for literally decades. So we can see all of their amazing, capital return stats. That's what the company does the best. They love returning capital to the shareholder because they're already investing in the future. They literally don't have anything else to do with the money. So of course, continue to benefit from Super Mario World, Orlando results. You can literally read through these. I like looking at the theme parks because it's kind of like Disney World. I don't know. But we can see that their revenue. So look at this. Here's what's impressive. So the revenue was up 1.2%, not crazy growth, not the craziest growth. But look at their EPS. It's up 13% because of the stock buybacks. So as an investor, you are getting real returns because of these stock buybacks. But anyway, now that we know what the company does, I want to go into more about the company's financials and show you how amazing they're actually doing right now. All right, so now's my favorite part of the video. We get a deep dive into Comcast numbers so you can see for yourself how amazing they're doing. So like we saw earlier, they have a $157 billion market cap, just a huge company. And here's their dividend history. Right now it's 31 cents. And, in 2020, it was 23 cents. So quite quite the growth. Each time they raise it 1 penny, that's about a 3% dividend raise, which is pretty cool. But anyway, let's see if they can afford the dividend based off their EPS. So look, 31 cents per quarter, and they made in the most recent quarter 96 cents. So they could afford 3 quarters of dividends just in 1 quarter based off their EPS. But what about their free cash flow per share? This is the number that I actually like to look at, and it was $1.99. So they could afford the entire year's worth of dividends just in 1 quarter. So let me actually visualize that number for you. So here's the free cash flow down here. They made $7.85 billion, which is up 8.58% from 1 year ago. So remember that number. So here's how much their dividend costs from that. Literally just $1.19 billion. That's literally nothing. They have so much room to raise the dividend and double it. So what are they doing with the rest of their money? Well, they're spending, 3 times as much money on stock buybacks than dividends. That's why their EPS is going up so much. They're buying back tons of their own stock, double and triple what their dividend cost. A couple quarters ago, they bought $3.5 billion just in 1 quarter. And that adds up. Remember their market cap. So if we go to their total common shares outstanding, we can actually verify that, yeah, we do actually own 5.84% more of the company. So that's why this company is just super impressive. Now, another thing a lot of people mention, which is really good, is that they have a lot of debt, but they also have a lot of assets. But let's see how fast they could pay off their debt. So let's check out their total debt right here. It's $100 billion. But what's good to see is that their debt is actually down 4.1% from 1 year ago. So 1 year ago, they had $100 billion. Now they have $96 billion. But remember, they have $100 billion of debt, and they made, nearly $10 billion in 1 quarter free cash flow. Well, 7.85 billion. So if you take the entire year worth of free cash flow, they could just stop doing stock buybacks if they wanted to and pay off their debt. But they have a sustainable amount of debt for the amount of assets that they have. Hope that makes sense, because look, the assets to liability ratio is 68%. There's some worse ones like Verizon and AT&T, which those are also very sustainable. With those kind of companies, you actually want inflation, because inflation helps the debt go away, makes it less valuable. But here's honestly why I think the company is trading at a low P ratio. Here's the truth about Comcast. Why are they trading at that 9 times forward P ratio? It's because look at their total revenue growth point of view. It's literally just flat. I mean, it's up from 2019, but over the past few years, it's basically just been chilling at this $30 billion level. And that's why I honestly think that the valuation is pretty low. But that doesn't change the fact that they're growing their free cash flow per share like crazy. Look, their free cash flow per share is up 15% from 1 year ago, and their EPS is up 6.53% from 1 year ago. So these green numbers at the bottom are the year-over-year growth rates. So we can see that they are actually growing their per share metrics, which is what we want to look at. And here's the thing that I honestly don't care about. I don't care that they trade at this low forward PE ratio because of this dividend yield, this juicy dividend yield. So they could not grow for another couple years. Let's say they keep their same net income. They could still double their dividend yield to a 6% dividend yield plus, and I'd be happy with that. A 6% yield in cash every single year, and they could stay at the same stock price. I don't really know. This is just my analysis. Let me show you what the analysts are expecting. Let me show you the analyst price targets for this, because that's also important. And here is also what the analysts are thinking right now. So right now, the price is $40, and the low price point is $40 for an estimate, and the high is a $55 stock price. So that's a 37% upside potential. But I want to show you the EPS forecast. So this is what's really important. So here we are in 2024. We're expecting 4.3, but if we scroll out to 2028, they're expecting a median of 6.2. So I want to do a little bit of calculation off that. So we'll pull out the calculator. And remember, right now they're trading at a 12 times PE ratio. So I don't really know what ratio we're going to use. So let's just do 6.2 times 12. So that means a $74 stock price. Remember, the analyst on the high side were expecting a $55 stock price. So that's just kind of my expectations. If they hit that $6.20 EPS estimate and they're trading at 12 times earnings, that's literally a $74 stock price. So yeah, guys, that was my analysis on Comcast. Hope you guys did enjoy, and if you did, please drop a like on the video. It really does help me out a lot. And if you drop a comment down below, I'll make sure to read and respond to every single one of them. I just enjoy doing that. So anyway, see y'all next time.